Good afternoon, everybody. My name is Emeka Oguh. I'm the CEO of People Joy. Welcome to our Student Loan 101 presentation today. We have a lot to go over, so I'm just going to ask that you hold your questions to the end. Quick about us, we were founded in 2016. We have an unmistakable love for helping borrowers figure out their student loans. That comes from the fact that we ourselves have dealt with student loans. We are dealing with student loans, and what we want to do today is really just help you with some best practices and understanding and managing your debt. So we're going to talk about we have a jam-packed agenda. We're going to talk about the CARES Act and some of the recent changes to student loans that has occurred with that. And then we're going to go through the entire student loan life cycle, from the first steps in student loan repayment all the way to deferment and forbearance, consolidation and refinancing, loan forgiveness, which is obviously a very important topic these days, and then strategies and tips for avoiding and recovering from delinquency and default. So just going to jump right into it. Under the CARES Act, if you have student loans, you're probably already familiar with this. Student loan payments are suspended through September 30th, 2020. And so that began on March the 13th in response to the CARES Act. And what that means is you don't have to make any payments until September 30th, and interest is not accruing on your loans through September 30th. So you have a 0% interest rate, and you don't have to make any payments until September 30th. If you do decide to make payments, if you do choose to make payments during this period, they'll have to be done manually. So you'll either have to call into your servicer or mail in a check to actually make payments on your student loans. And this will apply to any direct loan. So only direct loans owed to the federal government have the suspension enacted. If you have private loans, those payments still have to be made during the next few months. Then we want to talk about knowing your lender. So as I mentioned, with federal loans, the lender is the Department of Education. Typically with a federal loan, you have a lower interest rate and there's no credit check or cosigner required for the federal loan. With private loans, these are loans given to you by a bank or private institution. They generally will have a higher interest rate, and if you don't have a credit history, a cosigner is going to be required with that loan. With many federal student loans, the federal government is the lender. When you have received a student loan from the government, they're going to disperse that money. With private student loans, the lender is going to be a bank. In the past, the government has actually worked with banks to issue you money, but they stopped that practice in the early 2000s and went to actually give out the loans themselves through the direct loan program. You also want to know what you owe. Now, when you're going through school, you're going to have different servicers that will be giving you loans. You want to go to studentaid.gov. That's where you're going to find all of your federal loans. Private loan information can be found by running a credit report or contacting the financial aid office of the school that you went to. So with federal loans, where you're going to want to go to get this information is studentaid.gov. Now, this is going to be different from your servicer website. Your servicer is where you may go to make payments, but studentaid.gov is where you're going to get information on any federal loan you ever took in undergrad, graduate school, going for your PhD. Studentaid.gov is the one central site that has all that information. So it's the same place you went where you filled out the FAFSA. If you probably remember when you first went to school, you filled out a FAFSA form with your parents. It's the same place that you'll go. You went for that. And to log in, you're going to need your FSA ID. If you don't have that, just follow the prompts for getting that one or creating an account. Once you log in, you're going to see a screen similar to this, which is going to show your federal loan data. It's going to have a list of all the loans that you've taken out, principal broken down by principal, balance, any interest that's accrued, as well as any grants that you've been issued. Again, you wouldn't get this, and who your servicer is. So all that information will be on your student aid website. You'll also be able to download your My Student Data file. So this is a file that, again, contains all the information that you have, all the aid you've received, the loans and grants through the Department of Education. Depending on your browser, some browsers have issues with the studentaid.gov website. So our recommendation is if you have Chrome, use Chrome because that seems to work the best with downloading this information. If you don't have Chrome, we would just suggest downloading it. It's a free browser. Once you have that information, what you can then do is go to peoplejoy.com/loan forgiveness. Just click on Get Help Today free. And what we'll ask you is to upload the My Student data file that you just downloaded, as well as some information. And then we'll actually be able to let you know if you're eligible for loan forgiveness, if you're eligible for lower monthly payments. We'll do an analysis for you to let you know what you're eligible for. Okay. So the next thing you want to do is know your loan servicer. The loan servicer is the company that handles the billing and services on your federal student loan. They'll work with you on repayment plans and loan consolidation and will assist you with other tasks related to your federal student loan. Your loan is assigned to a loan servicer by the U.S. Department of Education after your loan amount is first paid out. And your loan servicer may change after your loan is originated. It's not uncommon for a borrower to have two different loan servicers. Every single year that you're in school, a new loan is issued to you. And because the Department of Education works with different servicers, there's always chances that they may work with a different servicer the following year and you have a new servicer. And depending on the type of loan that you get, you may be getting a loan from your school. For example, Perkins loans are issued by your school. That's going to have a separate servicer than, let's say, a direct loan issued from the Department of Education. So these are some examples of federal loan servicers. If you have a federal loan, these names will be familiar to you. Fed Loan Servicing, Cornerstone, Navient, Nelnet. Those names sound familiar. Those are federal loan servicers. With private loans, it's a little different in that the private lenders themselves will service the loans that they originate. So the Department of Education outsources the servicing to private entities, but some banks, for example, Wells Fargo, will do their own servicing. There are banks that will also outsource to third-party servicers, and some of the servicers, such as Navient and Nelnet, they manage loans for the federal government and they manage loans for private lenders as well. So you want to make sure when you're looking at your loan, you know if the loan is a federal loan or a private loan, because your servicer may be managing one or more private and federal loans. Another thing that's really important is to know the type of loan that you have. So there's several types of federal loans. You have direct Stafford loans, you have federal family education loans, there's Perkins loans, direct plus loans, and parent plus loans. And all that information is going to be found on that My Student data file that we talked about. The reason why it's important to know your type of loan is that different loan types have different payment plans, they have different forgiveness options, they have different subsidies that you can be eligible for. And you want to know what type of loan that you have to know what programs those loans may be eligible for, if any. Once you have your loan issued and you graduate or you finish school, you then will go into loan repayment. And the servicer that is collecting your loan repayment is going to contact you on behalf of the lender to let you know when your payments are due. However, it is your responsibility to make sure that you have the most up-to-date information in the NSLDS and with your servicer. So sometimes folks get in trouble because when they're getting those loans, they put maybe their home address when they live with their parents, or maybe a school address with the school apartment. They graduate, get a job somewhere else. They don't update that information. The servicer sends them a letter in the mail letting them know their payments are due. They never get it, and all of a sudden they get a notice that they're in default or that their wages are being garnished because they just never got any updates. So it's on you to go into the system and make sure you have the most up-to-date email address. If you use the school email address, typically schools will disable those emails, at a certain time after school. So it's on you to go in and make sure that you have the most up-to-date information with the servicer. Once you graduate, your loans go into a grace period. That's going to be a 6-month period during which you don't have to make any payments on your student loan. So it gives you time to start working, get everything in order. You can actually choose the repayment plan that you want, which we'll get into a little later. And that's going to last for 6 months. You can make payments during grace period if you want to start paying off your loan a little faster. You have the option to do so. Once you get out of grace period, your loan goes into repayment. Now, if you haven't elected to go into a different repayment plan, by default, your loans will go into a standard 10-year repayment plan. And so you'll be paying fixed monthly payments for a period of 10 years. All the payments are made monthly on the same due date. You do have the option to move your due date around if you want to time it with payday. You can call your servicer and actually get your payment due date adjusted. So now we're going to talk about repayment. So the government, the federal government, actually has several different repayment plan options for you. And this is where things can get a little confusing because you have so many options available to you. Some have eligibility for loan forgiveness, some don't. Some have fixed payments, some have payments that increase with income, some have payments that just increase every few years. So there's a lot to unpack here, and you want to make sure that you know the best repayment plan for you and use that to pick your long-term strategy. One thing to note is that you can actually change repayment plans as often as you like. So you're not married or stuck to one payment plan for the entire life of your loan. You can move around with payment plans based on your income, based on convenience. You have different options. So again, as I mentioned, the first payment plan is the standard plan. Fixed payments over 10 years. If you have a consolidated loan, it can be fixed payments for up to 30 years. The graduated repayment plan is similar to the standard, except that your payments increase over a period of time. So with the graduated plan, you're starting off with a small payment, and then gradually you're graduating to a higher step-up monthly payment over the life of your loan. The extended fix takes a 10-year standard plan, but instead increases it over a period of 25 years. So you're just taking a little longer to pay off your loans. The extended graduated works very similarly. It's to the graduated, except that it's over a longer period of time. And then you also have several income-driven repayment plans. So these are plans tied to your adjusted gross income. The government has plans put in place where if you come out of school and you qualify for a partial economic hardship, you can actually qualify for a lower monthly payment. And they have a tool that they use. There's a formula that determines if you qualify for these plans based on your income, based on marital status, based on dependents. It's a couple of things that go into the formula that will determine if you're eligible for these income-driven repayment plans. The benefit of these plans are that not only will they make you qualify for a lower monthly payment, you may also qualify for interest subsidies where the government actually will pay a portion of the interest that accrues on your loan. The benefit of that is that you have less money interest growing on the loan over time, so there's less to pay back over the long term. These loans will also qualify for forgiveness. In some cases, you can get your loans forgiven in as little as 10 years. In other cases, it may take 20 to 25 years, depending on if you work for a for-profit or nonprofit, and we'll get into that. But there's 4 different income-driven repayment plans, and each of them have different monthly payments that you will make depending on your discretionary income, and each of them have different subsidies and forgiveness options. So when you're looking at your repayment plans, again, you want to make sure that you are in the right plan for you for your given situation, and that can change from year to year, but that's something that you definitely want to make sure that you're knowledgeable of. So I want to give you a quick example to illustrate what you would as a borrower might be paying under each of these different repayment plans. So we have a borrower here who has $80,000 of student debt split between unsubsidized loans and subsidized loans. She makes $60,000 a year, and her weighted average interest rate on all her loans is 6%. So If she were to be on a 10-year standard plan at $80,000 of student debt, she'd be paying $888 a month. Her total loan cost on her loans would be $106,580. So when you calculate that principal plus the interest, she's paying back $106,000 over a period of 10 years. But let's say she decided to instead enroll in the graduated plan. She's going to start off paying $508 a month, so much lower than she would on the standard plan. So she's got a little extra cash in her pocket that she could, put to his other expenses or save. But by year 10, she's going to be paying $1,524. So she's paying a lot less in the beginning, but she's paying a lot more towards the end of her loan payments. And her total loan costs are going to be $113,696. So that gives you a sense of the trade-off between going into a plan that maybe starts at a lower monthly payment. The trade-off is that those payments will increase later on as you earn more income, as you start paying down the loan. Those payments will start to get higher. If you look lower into this table to the income-driven repayment plans, you'll see, for example, with the revised pay-as-you-earn, she starts off paying $344 a month, so really low. But by the end of her loan, she's paying $1,076 a month, and she's paying this over 20 years because we're stretching out her loan and it's tied to her income, and she's going to be paying close to $152,844 back based on that plan. So this just gives you, again, an example of the different types of repayment plans that you can enroll in and how long it will take you to pay them off and the total loan costs of these different plans. So when you're choosing your plan, you want to make sure that you know what the long-term outlook is going to be for that loan. And if there are any options, again, for forgiveness, if there's any way to cancel some of those loan payments back based on where you work and your income. So some things to note: if you had a change in income, you can ask to have your monthly repayment calculated at any time. So those income-driven repayment plans are based on your income. So if you've lost a job, if you've gone from full-time to part-time, these are all things that can lower your monthly payment. When switching into an income-driven repayment plan, you can ask for a 60-day administrative forbearance, so you're not making any payments for the first 60 days as you move into the plan. Based on your income, you may qualify for an interest subsidy or a $0 repayment plan where what is required from you on a monthly payment is $0 a month. The good thing about these $0 repayment plans is that they qualify for public service loan forgiveness. And also, whenever you make a change to your income-driven repayment plan, that change is locked in for a period of 12 months. So if you had a change in your income, you enrolled in an IDR plan or changed it, whatever changes you make, your new monthly payment is going to be locked in and set for the next 12 months. So I want to do a quick case study on the income-driven repayment plan, because that's really where I think you can get the most advantage and most savings if you're eligible for it. We have a borrower who her biweekly paycheck is $2,000. So, annual salary of $52,000 a year. She has a loan balance of $27,000 and an interest rate of 4.42%. On a 10-year standard plan, she would be paying $278 a month. But if she enrolls, let's say her income drops, so she went part-time, or she was furloughed, or she's there's an instance where her income gets dropped. Now she's making $36,000. If she enrolls in an IDR plan, her monthly payment is only going to be $148 a month versus what she would be paying $275 under a 10-year standard. So she's saving close to $150 on her monthly payments. Now, let's say she was completely unemployed. She has the option to go into forbearance and not make any payments, or she can actually enroll in an IDR plan, and based on her salary, she wouldn't have to make any payments, and the government would actually pay a portion of her interest. So that's the benefit of a IDR plan is that no matter what you earn, um, you may qualify for a lower payment, and the government will actually pay a portion of your interest. And those payments, those non-payments, those $0 payments, will still count towards public service loan forgiveness. So with private loans, there's a lot less options there because they're not backed by the Department of Education. So you want to talk to your private lender to understand if they have any repayment or deferment options with private loans. Some repayment tips: if you haven't already, make sure you enroll in auto debit. Most servicers will give you a 0.25% interest rate discount if you're enrolled in auto debit. It's important to make your payments on time. Payment history does go on your credit report. And as we talked about, extending your payment term can result in a lower monthly payment, but a potentially higher overall cost. And you want to make sure you pay in full every month. It's also important to note that a portion of your student loan interest can be tax deductible. So you want to consult with your tax advisor and the IRS to understand how much of your interest you can deduct each year from on your taxes. So it's always nice to get a good tax break at the end of the year for those extra interest payments on your student loans. So now we're going to move into the topic of deferment and forbearance. So deferment or forbearances allows you to either suspend or postpone payments on your student loans. Normally, you would have to apply and qualify for either of these plans. Uh, the only exceptions are when you're in school. When you're in school, you're going to be automatically placed into an in-school deferment if you're in school at least half time. So whatever your school designates as full time, if you have at least half those credits, the servicers will put your loans into an in-school deferment, meaning you don't have to make any payments on those loans while you're in school. The other exception is the environment we're in right now. With the CARES Act, the government put all federal loans automatically into a forbearance state. So whether you wanted to or not, your loans were automatically put into forbearance, and they're going to be that way until September 30th, as I mentioned earlier in our presentation. But normally you would have to apply and qualify to get your loans into forbearance or deferment, and that's going to be for a period of 1 year, and then you'd have to reapply if you want to remain in forbearance or deferment. The next topic we're going to talk about is consolidation and refinancing. So these terms are often swapped, but they mean very, very different things. So consolidation is combining multiple federal loans into one direct consolidation loan for one monthly payment. You're essentially just combining all your loans together. Your interest rate's not going to decrease or increase. It is just going to be a weighted average of all the loans that you put together. You cannot consolidate private loans into the federal government. You can only consolidate federal loans, and no credit check is required. It's just a form that you fill out with the Department of Education and you send to your servicer. Refinancing, on the other hand, is essentially refinancing private and federal loans together for one monthly payment. And so that's where a bank is essentially paying off whoever had your loan last, and now they own that debt. And so in order to qualify for refinancing, you have to have good credit, and you have to apply with the bank and get approved. You can get rejected for refinancing, whereas with consolidation, it's just a form that you fill out. One thing to keep in mind, when you're refinancing with a private lender, you lose all federal benefits such as deferment, forbearance, forgiveness, the interest payment suspension because of the CARES Act. That only qualifies for federal loans. Once you refinance with a private loan, you forfeit that. So just a quick summary. It's a nice table to keep in mind. With consolidation, you can consolidate federal loans. You can also refinance federal loans, but you cannot consolidate private loans. You can refinance a private loan. So if you have a private loan with Sallie Mae and they're charging you 8%, and you find out that SoFi is going to give you 6%, you can refi your private loans to SoFi to get that lower interest rate, but you cannot take SoFi loans and consolidate them into a federal loan. So it doesn't work the other way. With consolidation, it's not lowering your interest rate, it's just averaging everything together. With refinancing, you may get a lower interest rate. In both cases, you're going to get one monthly bill. With consolidation, it may actually make your loans eligible for loan forgiveness. With refinancing, as we mentioned, those loans are not forgivable. And in both instances, you may be able to save money through lower interest rates, through loan forgiveness, and through federal subsidies. So now we're going to go and talk about loan forgiveness. So we're going to specifically want to talk about public service loan forgiveness. If you work for a nonprofit, a local government, so if you work for the city of Philadelphia, if you work for the state government, you're in Harrisburg, or you work for a federal government, you are eligible for federal student loan forgiveness. After 10 years of full-time work, the Department of Education will forgive the remaining balance of your student loans tax-free. So it's a really great program if you qualify for it. There are a number of steps that it requires. Step one is you have to be in a qualifying repayment plan for your eligible loans, and you have to recertify in those plans annually. Step two is if you have loans that are not qualified for forgiveness, you want to consolidate those loans into a direct loan to make them eligible for forgiveness. You also want to submit a employment certification form to Fed Loan Servicing every year. And then you have to make 120 on-time monthly payments while working at a qualifying institution. And then once you've done that, you will then apply with Fed Loan Servicing for actual forgiveness of your student loans. So this is what the employment certification form looks like. You just want to fill that out, and you're going to have your employer sign off on it, and then you're going to send that to MyFedLoan, which is the servicer that handles public service loan forgiveness. So the eligible loans that qualify for loan forgiveness are any loan that is in the direct loan program managed by the Department of Education. If your loans are not in the direct program, you can convert them by consolidating them through the direct consolidation loan program. Qualifying payments have to be done through one of the income-driven repayment plans. So that's the income-based repayment plan, pay-as-you-earn, revised pay-as-you-earn, income contingent repayment. The payments do not have to be consecutive. So if you made 12 on-time payments and then you had to take a break, or you stopped working, you can just pick up where you left off. The timer doesn't reset. So that's one of the benefits of the program, which allows for changes in employers and periods of non-work. Qualifying work means that you have to work for a total of 10 years. Again, it doesn't have to be consecutive in a public service position. So if you work for a nonprofit tax-exempt 501c3 organization, that includes many medical schools, residency programs. Again, as I mentioned, it's the city of Philadelphia. Then you work for a 501c3. Federal, state, local, or tribal government organizations also qualify, military as well. If you're not sure that your employer qualifies, you can actually contact Fed Loan Servicing. They are the servicer that oversees the public service loan forgiveness program. One other thing to note, if you work part-time at 2 or more nonprofits, you can still qualify if the combined average that you work per week is 30 hours or more. So if you work 15 hours at one employer part-time, and you work 15 hours at another employer part-time, together that qualifies for public service loan forgiveness. So I want to show you that same table of payments that we showed earlier in our presentation, but now with those payments qualifying for public service loan forgiveness. What you'll see here is with the income-based repayment plan, because remember the income-based, the pay-as-you-earn, the revised pay-as-you-earn, and the income contingent, these are all plans that qualify for public service loan forgiveness. You'll see that you end up paying a lot less on these plans because your loans get forgiven after 10 years. So for example, with Sam, if she was on the revised pay-as-you-earn, she's only going to have to pay back $54,605 because the remaining balance of her loan get forgiven after 10 years. So if you qualify for public service loan forgiveness, it's really can really be a huge benefit and save you a lot of money. So again, some key takeaways: you want to be in a qualifying repayment plan. You have to make 120 qualifying payments. You have to be employed for a total of 10 years in a nonprofit or public service position. And remember to submit the employment certification form, have your employer sign off on it every year.
Can I ask a quick question?
Yes.
In the 10 years, is that consecutive, or like if you happen to go into the for-profit world for a year and go
Yeah,
back?
great question. So you can take time off. You can go into the for-profit world for a year, and when you come back, you'll just pick up right where you left off. And that's why it's important. You want to make sure that you certify your employment history every single year so that when you leave, they have a documentation of, okay, you've worked here for 36 months. And then if you decide to come back to the nonprofit world, you'll just pick up from month 36 and continue onwards. So it allows you to take breaks. It allows for periods of non-work. It doesn't have to be consecutive. So we have folks who, it takes them 12, 13, 14 years to actually get their loans forgiven because they've had periods of non-work. They've had periods where they were in forbearance. So it does allow for that break in payments. There are other forms of forgiveness. So teacher loan forgiveness allows you to have up to $17,500 forgiven, depending on if the subjects that you teach, and that's after a period of 5 years. Unlike public service loan forgiveness, that does have to be consecutive. So the teacher loan forgiveness does not allow for breaks. You do have to work, I think, at least 6 months out of the academic year to qualify for teacher loan forgiveness of up to $17,500. Perkins loan cancellation, same rules apply. You can get your Perkins loans canceled after 5 years if you have a qualifying position. That's Peace Corps, teacher, if you're a nurse, law enforcement officer, family services, and early intervention workers. You can actually get your Perkins loans canceled after 5 years. So with both of these other forgiveness programs, you want to look and see which is the best one for you. Because, for example, if you take teacher loan forgiveness, you can't apply teacher loan forgiveness and public service loan forgiveness to the same set of loans at the same time. So there's certain nuances and rules that apply, and you want to make sure that you choose wisely. Otherwise, it can actually hurt your chances for other types of forgiveness.
Can I ask a question?
Please.
Are you able to apply past public, service work, or once you move out of that sector, you kind of can't use it anymore?
You absolutely can. So you can always retroactively reach out to a prior employer and send them that employment certification form with your information on there, and then your employer has to verify the period of time that you worked for them, and that whether you worked for them full-time or part-time. So you have to have an authorized official from a prior employer, and that's something that you can do. We do that a lot with our clients because most borrowers have not certified with their prior employers, and they have changed jobs. So this is a very common occurrence, and you want to make sure that so you do have the option to go back with prior employers and get that time certified. There's no expiration date or deadline for when you can get those filled out, but you have to get one signed by each of your prior employers and then get that sent to My Fed Loan. And then what they'll do is they're going to take that information, they're going to look at the periods of time that you worked for that employer, and then they're going to look at your payments that you made during that time period, and they're checking to see were these qualifying payments. So were you in the right repayment plan? Were your payments on time? Did you have the right loan type? And then if any of those things don't line up, they may come back to you and say, well, this month doesn't count. Not because you didn't work at a nonprofit, you did, but because, you know, you were in the wrong repayment plan, or you had a late payment, or you were in a pay-to-head state, that's where it can get, things can start getting a little more complicated. And so there are programs also in place for if you were in the wrong repayment plan. There's, for example, the temporary expanded public service loan forgiveness program, specifically for people who are in the wrong um, repayment plan, which you may qualify for. So there are instances where even if you get rejected, we could still help, or you can still find ways to have those payments still qualify. Um, if you even if you didn't check all the boxes for public service loan forgiveness.
Thank you.
You're welcome. So with avoiding delinquency and default, student loans are not dischargeable in bankruptcy. It is one of probably the only type of debt that you can't discharge in bankruptcy. They make it very, very difficult. Late payments are reported to the credit bureau, typically 30 to 90 days, after 30 to 90 days of missed payments. So if you're a day or two, or even a couple weeks late with your student loan payment, it's not the end of the world. You can still make that payment and it won't impact your credit. It's, you know, after 30 days though is when you want to start to be concerned. If you do go into default, so your loans, your federal loans are considered in default after 270 days of missed payments. So before then, it's considered delinquent. But once you've had 270 consecutive days of non-payments, your loans will go into default, and then they get assigned to a collection agency. Once they're assigned to a collection agency, the loans become immediately due and payable in full. You lose eligibility for repayment plans, deferment, and forbearance, and loan forgiveness. Again, the eligibility loss is temporary, so you can get out of default, and we're gonna talk about how. But you do lose eligibility for those plans while you're in default. Obviously, calls from collection agencies, which nobody likes. You may get your wages garnished, and your employer has to garnish your wages. If they don't, the loan can actually be reassigned to your employer. So they're going to garnish your wages. They can garnish your tax refunds as well as your Social Security income. One thing to note, if you are in wage garnishment, during the CARES Act, during the suspension, collection agencies cannot garnish your wages. So if your loans are currently being garnished, contact your HR department and let them know that the collection agencies cannot garnish your wages. Federal loans cannot be garnished through September 30th because of the CARES Act. So it's one benefit there. So getting out of default. Obviously, as we mentioned, you can repay the loan in full. You can also consolidate the loan and agree to pay under an income-driven repayment plan. You can make 3 on-time monthly payments and then consolidate the loan. And then the last step is you can rehabilitate the loan by making 9 on-time payments consecutively. The benefit of rehabilitating the loan is that after you've made those 9 on-time payments, they will actually clear the default off of your credit report. So that gives your credit an immediate boost because they'll wipe it clean as if it never happened. Whereas with consolidation, it doesn't get cleared off your credit report, so the default will still show for a period of 7 years on your loan. So we typically recommend our clients, if you're in default, let's try to get you into the rehabilitation program, because that's think of it as a get out of jail free card. In fact, you can only rehabilitate your loan once. So if you get into default, you can go through the rehabilitation program. But if you default again, that option is off the table. You only have one of the other 3 options available to you. So some resources. One, just talk a little bit about what we do at People Joy. Obviously, choosing the right program and staying on top of it can be complex. Do you refinance or do you enter into an income-driven repayment plan? You have to decide what's right for you. And then choosing the right income-driven repayment plan. The best plan for you may vary from year to year, depending on what you earned, where you work, your marital status, the number of dependents that you have, what you're contributing towards your pre-tax benefits, such as your 401k or HSA. Those all impact which IDR plan makes the most sense for you. And then maintaining eligibility, as we mentioned, if you qualify for public service loan forgiveness, if you've forgotten to recertify with your prior employers, reaching out to them, getting the paperwork signed, that can take time. So what we do at People Joy is we help with that. So again, as I mentioned earlier in our presentation, it starts with a free analysis. Based on where you work, we'll let you know if you are eligible and qualify for public service loan forgiveness and what you need to do. If you want to work with us, and again, it's an option, not an obligation, we can actually do the paperwork for you. We can help you with just developing strategies on an ongoing basis around your student loans, and that's something that we do with a lot of our clients. Just want to give you a quick case study of an individual borrower that we worked with recently. Works for a nonprofit, has a master's degree. She has $48,000 in student loans and was earning $44,000 a year. She was actually in a payment plan that was paying $708 a month. So she didn't realize, because she worked at a nonprofit, she needed to be in an income-driven repayment plan. So we found a plan that actually lowered her payment from $708 to $208 a month, for a savings of $500. And she also had never reached out to any of her prior employers and certified her her employment history with them. So we reached out to her prior employers, got the paperwork done, sent it to her servicer. We were able to get her 30 months of payments certified. So she's now much closer to getting forgiveness. And we're helping her every single year, reevaluating her strategy, looking for ways that she can get the lowest monthly payment and the largest amount of loan forgiveness. So some strategies will include maximizing your 403B or 401k, because that actually reduces the amount of income that you have to report at the end of the year, things like that, to help her lower her monthly payment. So when it's all said and done, she's going to get close to $47,000 of loan forgiveness. We also got some of her payments that didn't qualify initially. They're going to qualify under the temporary expanded public service loan forgiveness program. So again, a program that was set aside specifically because servicers did a not so good job of communicating what needed to be done for public service loan forgiveness. So the government instituted a temporary program specifically to address that issue. So some helpful websites. Again, if you want a free assessment, you can go to peoplejoy.com/loan forgiveness. Studentaid.ed.gov has a lot of the information that we talked about today. You can read up on it in each of the different programs. And again, you can always, everything that we mentioned today is available on studentaid.ed.gov. You can actually enroll in all these IDR plans and PSLF, et cetera, through your servicer. If you want help with optimization and strategy and what the best plan is for you to, save the most money and get the most forgiveness, feel free to contact us at peoplejoy.com/loan forgiveness. The nslds.ed.gov site, it actually now points to studentaid.ed.gov. They've recently merged the two websites, but that's where you're going to go to download that My Student Data file, and that's the file that has all your loan and grant information that you have for all your loans. If you did want to work with us, that's where we would direct you, because we need all that. We need an accurate history of your student loan information to see what you qualify for and when. If you're interested in learning about that student loan interest tax deduction, you can go to irs.gov. If you want to know, if you're not sure how much you have in student debt, private loans, you can always go to annualcreditreport.com and get a free credit report. And paying off your student loan, it requires setting a goal. So you want to pick a date in the future. If you want to be paid off in 10 years, let's do that, right? If you want to get your loans forgiven in 15, let's do that. But it all starts with having a budget. So Mint.com is one that you're probably all familiar with. YouNeedABudget.com is also another budgeting tool. That one is fee-based. You can also just use an Excel sheet, right, just to keep a monthly budget. But it does, really paying it off your loans requires, setting a budget and sticking to it. But once you have that set up, you're just going to start seeing that loan balance melt away. So that's our presentation. I'm going to appreciate everybody listening in, and I'm going to open it up now for any more questions.
I have another question around, you talked a little about if you refinance, basically you can't qualify for a lot of things. So if you refinance, do you qualify for anything? Can you unrefinance your private loans or whatever? I'm just curious
Yeah.
to see what
So
options are available.
So with refi, really, I mean, you can always get a lower interest rate. And so when you're looking at refinancing, what we like to do is we'll evaluate, okay, what are your options under the federal loan program, right? And then we're going to compare that to um, what you may qualify for with a lower interest rate. Uh, but once you refinance, no, there's no coming back. The only thing you can do is see if you can refinance to a lower interest rate. Now, some private companies, some private lenders do have programs, relief programs, if you lose a job or anything like that, where they may say, okay, for the next 3 months, you don't have to make any payments, but beginning month 4, you have to start making payments again. Some have the option to have interest-only payments for a year or more, depending on if you're in residency, for example, and you're a doctor. They'll have flexible programs. So it really is on a servicer by servicer level with private loans. So what you're going to want to do is, if you are looking at refinancing, you just want to, those are questions you want to ask, this usually in the FAQ. If something happens where I need to take a break or anything like that, what are my options? And then it's going to be dependent on that specific that private lender who issued you or refinanced your debt.
Got it. Thank you.
This isn't so much as a question as it is a thank you for reminding me to include the student loans in my taxes. I almost forgot last year, and it was the difference of a couple $1,000. So
Yeah.
doing that this weekend. So I appreciate the refresher.
Absolutely. No, you can deduct up to $2,400 of interest, student loan payment interest, from your taxes. Another benefit out of the CARES Act, and I didn't talk about it in this deck, is that if you have an employer that's making a matching contribution to your student loans, they can actually make a matching contribution tax-free through the end of the year. So normally, let's say your employer said, hey, I'm going to help you, I want to help you pay off your student loan. So Jake, I'm going to give you $100, right? You would have to, that would be considered additional income to you. So you'd have to pay taxes on that $100. So you're only going to be getting $75, right? Because you have to pay taxes. But from now to the end of the year, if they give you $100, you don't have to report that as income, and you can just put it directly to your student loan, and you can get that paid off that much quicker. So if your employer offers that, take advantage of it. If not, they have the means to do so. I would suggest
Okay, yeah,
because it's, and we're hoping that because that's because we also facilitate that program, so we do work with employers to offer that program. Um, we're working with a group of folks in Capitol Hill to see if we can actually make that tax break permanent. So it was just introduced because of the CARES Act, because of the coronavirus, the pandemic, but we're pushing to make that permanent so that it's a longer term benefit, because even a $100 monthly payment from your employer can help you save 2 to 3 years off the life of your loan, right? And so if you're not working for an employer that is eligible for public service loan forgiveness, that's really that's a great benefit, right? Because you're paying $400 a month, your employer is giving you an extra $100 a month. That's 25% more a month, right? And that starts to just snowball over the course of your payments, especially in the first years of payment, because years 1 through 5, I would say, of your student loan payments, most of that money is going towards interest. Very little is actually going towards your principal balance. Most is just going to the interest that goes directly to the lender. So any overpayment you make in the beginning part of your early years of your loans helps you pay off that loan that much faster, because you're putting more money towards your actual loan that you owe and less money towards those extra interest payments that don't drop your loan balance down.
Gotcha. Yeah, it's good to know.
Cool.
All right.
Well, again, you can, if you have any questions, you can email us at info@peoplejoy.com. You can call us at 1-800-653-1812. We're based here in Philly. We work out of 34th and Market University Center. So we're in University City. I'm actually in the office today. So it's empty here. But yeah, hope this was a helpful webinar. And again, if you have any questions, contact us. If you want a free assessment, peoplejoy.com/loan forgiveness. And really appreciate everybody's time on the meeting today.
Awesome. Thanks a lot, Emeka. Yeah, it was a lot of great info.
Thank you. All right, have a good one.
All right, take care.
So.